Hey everyone, welcome to the channel The Formula for Success and Wealth, where we focus on building assets and living wisely. So how would I invest my first $10,000 if I were starting completely from scratch as a beginner? Before we dive into that, just a quick update. One of my main portfolios recently reached a new all-time high of about $1.1 million. I'm genuinely pleased with that milestone, especially considering how the stock market has been performing lately. But I know many of you often ask, Steve, if you had to start over from zero, how would you distribute your money in the stock market? That's exactly what this video is about. I'm going to walk you through the 4 different types of assets I would personally include in my portfolio. Keep in mind, this is the approach I feel comfortable with. Everyone should assess their own risk tolerance, but you might find some of these strategies useful if they align with your goals. To kick things off, I'd allocate roughly $3,000 to $4,000 to the S&P 500. If you're not familiar with it, S&P stands for Standard & Poor's, and the 500 refers to the largest 500 companies in the United States. If I were just starting out, I'd steer clear of buying individual stocks, as they tend to be riskier. Back when I began investing, I picked random stocks like Honda and a bunch of dubious penny stocks, which ended up costing me a significant amount of money. That's an experience I wouldn't wish on anyone watching. One piece of advice I'd give my younger self in my early 20s is to start off diversified with the S&P 500. When you buy a share of a fund that tracks the S&P 500, you're effectively investing in the 500 biggest companies in the US. That includes giants like Microsoft, Google, Amazon, MasterCard, Visa, Costco, Waste Management, and many others. Just look around you. Chances are you'll see at least one brand that's part of those 500. The S&P 500 can be thought of as a sort of market elite, made up of companies that have consistently proven they can generate profits. Most of them have been around for decades and have weathered multiple economic downturns. Personally, I invest in an ETF that follows the S&P 500, called SPY. There are other similar ones like VOO, SPLG, IVV, and FXAIX. That last one is a mutual fund. I go with SPY because even though it has a slightly higher management fee, it's the most traded ETF in the world. That translates to high liquidity and volume, which is especially useful when selling covered options on the shares. If your plan is purely long-term investing without dealing in options, then VOO, SPLG, IVV, and FXAIX are all solid choices as well. In fact, several of them, like VOO, have lower expense ratios than SPY. For those who find SPY and VOO's share prices around 500 a bit steep, SPLG offers a more affordable alternative per share. Ideally, you should pick just one ETF that mirrors the S&P 500. There's no real benefit in holding a little of each, since they all track the same index and only differ by their managing firms. Once you choose one, keep adding to it over time. There's a chart that shows how the S&P 500 has performed over the years. On average, it tends to yield an annual return between 7% and 12%. That doesn't mean it increases within that range every single year. Sometimes it drops 20%, other times it climbs over 20%. But over a longer time horizon, that average holds fairly steady. My second choice would be to invest in something that tracks the NASDAQ 100, which is made up of tech-focused companies. If I were starting today with decades ahead of me to invest, I'd probably allocate a bigger portion to this sector. However, it's important to understand that tech stocks can be more volatile in the short term. If market dips or corrections stress you out, this might not be the best route for you. In my case, I have a higher tolerance for risk, so I don't mind having part of my portfolio in more volatile assets. Like the S&P 500, the NASDAQ 100 represents a collection of the largest 100 technology companies in the US. Some ETFs that follow this index include QQQ, and for those seeking lower share prices, QQM is a great alternative. These funds are typically composed of companies like Nvidia, Tesla, Meta, and Google. There is some overlap between tech ETFs and those based on the S&P 500, since many companies appear in both. But the key difference is that tech ETFs assign greater weight to those companies. There's also a chart available that tracks QQQ's performance, which is the one I personally use. You don't have to pick that one specifically. There are other options available. I prefer QQQ due to its high trading volume and liquidity, which also makes covered call selling easier. But if you're just beginning and prefer something cheaper per share, QQQM might suit you better. Third, I'd invest in ETFs or stocks that pay dividends. I get that these might not seem as exciting as fast-growing tech companies, but I personally enjoy receiving income monthly or quarterly through dividends. One of my go-to picks is the ETF SCHD, which focuses on dividend-paying stocks. Of course, you can choose whichever one aligns more with your style, but SCHD is a staple in my portfolio. It includes companies like Pepsi, Coca-Cola, and Home Depot, all of which have solid dividend-paying histories. It's good to understand that although these companies might not expand as rapidly, they offer steady cash flow through regular payouts. Tech firms tend to be more vulnerable during market downturns. When the market faces corrections or bad news, those companies, especially the ones that don't pay dividends, often experience sharper declines. On the other hand, more stable, dividend-paying stocks generally hold their value better. Sure, they still lose value during rough patches, but they tend to be less volatile overall. If you're someone who wants passive income or prefers a more stable portfolio, dividend-focused stocks, or ETFs, can be a great addition. In my own portfolio, for example, here's a snapshot of what I received in the latest round of dividend payments, roughly $241 from the ETF SCD. I also hold some shares in Waste Management, received $33.15 from a unit of Lockheed Martin, and even Meta, which now also distributes dividends. Consistent payouts from companies like Microsoft, Home Depot, MasterCard, Costco, and Lowe's form a reliable base. The fourth pillar of my approach involves holding a portion of my wealth in cash. Although some people disapprove of this, it personally gives me peace of mind. Keeping a cash reserve allows me to take advantage of dips or market corrections. By purchasing stocks I believe in at more favorable prices, I usually allocate between 5% and 10% of my portfolio to liquidity. If you use brokers like Fidelity that offer returns on uninvested balances, this can be a smart way to keep money idle temporarily while still earning some yield. In my case, idle funds are automatically moved into a money market fund, which, the last time I checked, was offering around 4.9% annually. If I were to design a more balanced portfolio, I would place something like $4,000 in an S&P 500 index fund. For me, that would be SPY. Approximately $3,000 in tech-oriented ETFs such as QQQ, $2,000 in dividend-focused assets like SCD, and retain $1,000 in cash. However, if I were younger, I'd likely increase my exposure to technology, which is why I currently have about $55,000 invested in that sector, adjusting the other allocations accordingly. For someone aiming to generate income or looking for a more conservative strategy, I would consider putting $4,000 into SPY, $1,000 into QQQ, and $4,000 into SCD. And for those who prefer to keep things as simple as possible, allocating nearly Everything, say $99,000, into a single ETF tracking the S&P 500 and keeping a small amount in cash could be the way to go. When I talk about building a portfolio that delivers regular dividends, I'm not just referring to picking any company that pays out profits. It's essential to look at their track records, how they perform across different economic cycles, and whether they maintain payouts during downturns. Firms like Johnson & Johnson, Procter & Gamble, and Coca-Cola are prime examples of businesses with long-standing stability and consistent dividend payments. These are the types of companies often included in more conservative, income-driven portfolios. It's also worth noting the sectors traditionally known for strong dividends, like energy, banking, telecommunications, and utilities. Although these areas don't offer the explosive growth seen in tech, they tend to provide more stable income. Moreover, dividend-focused ETFs, like the SCHD I mentioned, offer an efficient way to gain exposure to such assets without having to evaluate each company individually. A commonly overlooked factor is dividend reinvestment. Instead of withdrawing those payments, you can use them to acquire more shares or ETF units, thereby growing your income-generating base. Over time, this strategy can snowball, with dividends compounding through each new distribution cycle. I also believe it's important to point out that not all funds must be invested at all times. Keeping some cash within your account gives you the ability to act fast when opportunities arise. Many assume they're wasting time or money by letting some cash sit idle, but in specific moments, that patience can prove extremely beneficial, especially when that cash is parked in a vehicle, like a market fund, which yields returns without exposing you to volatility. Even within this more conservative framework, you can tweak your strategy as your goals evolve. As your experience grows or economic conditions shift, it's natural to adjust allocations and seek a new balance between safety and growth. What truly matters is being clear about what you aim to accomplish with your investments and shaping your portfolio accordingly. Ultimately, what counts is that each person invests in a way that feels right for them. After all, it's your money at stake, and following generic advice blindly doesn't make sense unless it aligns with your individual profile. I always go back to the idea that there's no one-size-fits-all formula or universal answer. Everyone is at a different point in life, with unique goals, risk tolerance, and timelines. The goal is to create something that feels right for you, inspires confidence, and positions you well for the future. If this content gave you a clearer vision of how to make smarter financial choices, don't forget to hit the like button, subscribe to the channel, and leave a comment below. It really helps. Stick with us for more valuable insights on how to build a wealthier life with purpose and strategy. I'll see you in the next video.